In today's video, I'm going to be covering 10 terms that I think you need to know before taking the plunge into investing. Hey wealth builders, and welcome back to The Bemused, where we are making sense of all things money for the bewildered and confused young adult. This video is the second video in our Making Sense of Investing series. So if you're new around here and want to start from the beginning, I'll make sure I have a card linked up here so you can watch the series all in order. I hope that by the end of the video, you'll choose to come join the Wealth Builder Squad by hitting that subscribe button and turning on that notification bell so that you can get more videos just like this and keep up with us in this investing series and with all of our other personal finance content that we have for you guys. So the first term that I want to talk about is asset class. Asset classes are essentially investment categories. They're just ways to group similar types of investments together. Now there are four main asset classes out there. The first one is equities, and equities mean that you own a piece of a company. Probably the most popular type of equity investment is a publicly traded stock like an Apple or a Google or a company like that. Directly investing into a private company is also a type of equity investment. Now, equities can have a lot of risk. The stock market can be pretty volatile, and small companies, private companies, do have the potential to fail. However, there is also the potential and opportunity for tremendous upside when investing in equities, and it provides great opportunity for growth. The second asset class I want to talk about is fixed income. With fixed income investing, you're essentially making a loan to an institution or the government, for example, and they are paying you back with interest. A very popular type of fixed income investment is bonds. Fixed income in general is considered less risky than equity investing, but they also typically yield lower returns. Bonds issued by the federal government, for example, are considered pretty safe because it's not very likely that the federal government's gonna go bankrupt and not repay you your money. The third asset class is cash. This is just your plain old cash, money sitting in your savings account, which can yield you, a little bit of interest here and there, or just sitting in a checking account. As you know, cash is considered to be very safe, but it also doesn't really yield much of a return. The fourth main asset class I want to talk about is real assets and commodities. So this is when you own a physical asset like property. I know a lot of people are into real estate investing these days, and also that includes commodities like gold or oil, physical products, natural resources, and precious metals. So those are asset classes. Now let's move on to the second term, which is risk tolerance. Now, each of the asset classes we just named have varying degrees of risk and volatility involved. The amount of risk that you feel comfortable taking is what's called your risk tolerance. So if the thought of putting all your money into a volatile asset like stocks, for example, freaks you out, then you probably have a low risk tolerance. However, if you see a more volatile investment as an opportunity to experience more growth over time, then you probably have a higher risk tolerance. Now, just because you might feel comfortable taking on a lot of risk doesn't necessarily mean that you can or you should. For example, if you're saving up for a down payment on a house in the next few months to a year, you definitely wouldn't want to put all of your money in a very risky asset and have the chance of losing value right when you need that money. This concept illustrates what's known as your risk capacity. How much risk are you literally capable of taking on? The fourth term is time horizon. How much time do you have to save toward your investment goals? This one's pretty straightforward. In the home purchase example that we just discussed, the time horizon there was a few months to a year, which is pretty short. On the other hand, if you're in your 20s investing for retirement, that's a pretty long time horizon. We're talking about the span of several decades here. Your risk tolerance, risk capacity, and your time horizon all help shape your asset allocation. Asset allocation refers to the amount of money that you decide to invest into each asset class. So for example, if you have a high risk tolerance, high risk capacity, and a long time horizon, you might feel very comfortable investing most of your money into an asset class like equities, where you can ride out that volatility over a long amount of time. On the other hand, if you have a low risk capacity, low risk tolerance, and a short time horizon, you might want to invest primarily into a less risky asset class like fixed income or cash. The next term is basis. In simple terms, your basis is how much of your money you've contributed into an investment. So for example, if I contribute $1,000 into my Roth IRA and invest it, and now it's worth $1,300, $1,000 is my basis, because that's how much I put in. This term will be even more important later in the series when we get to talking about how investments are taxed. The seventh term is return. Now I know I've been using this term throughout the video so far, but I think it's important to clarify exactly what return means. Return refers to the gain or the loss on an investment relative to the amount of money that you contributed, or your basis. And it's usually expressed in a percentage form. Your return can be positive or negative. So for example, if I invested $100 and my investment is now worth $90, my return is negative 10%. Or if I invested that $100 and now it's worth $115, my return would be 15%. There are actually several things that can be factored into calculating the total return on your investment, and we'll get into that later on in this series as well. Next is expense ratio. If you're putting your money into a fund that contains several different types of investments, more than likely that fund will have what's called an expense ratio. The expense ratio measures how much of the money that you invest into the fund is actually going to things like administrative costs and fees. This is one of the main types of fees that are commonly found in investment products. You want to make sure that any expense ratios you're paying are reasonably low, because the more money you have going to fees is the less money you have actually being invested and working for you. But how do you know if an expense ratio is reasonable? And how do you even know if your investments are performing well? How do you even measure that? A helpful way to answer those questions is to compare your investments to their benchmarks. Many types of investments within each asset class have established funds that serve as benchmarks for investments that fall within that asset class. For example, the S&P 500 index represents the 500 largest companies in the United States. So if you are investing primarily in large US companies, the S&P 500 would be a good benchmark for you to determine, hey, how is my portfolio performing relative to, how it should be, how most assets in this asset class are performing. The 10th and final term is liquidity. How accessible are your investments? How quickly can you turn your investments into cash? Things like publicly traded stocks and bonds are considered relatively liquid because you can sell them pretty quickly on the open market. On the other end of the spectrum are investments like real estate property. You can't just sell a property to access the cash you put into it with the snap of a finger. So real estate investing property would be considered more illiquid. So those are the 10 terms that I find really helpful to understand before you start investing. If you got value out of today's video, make sure you comment the word value down below. And if there are any other investing terms that you guys find useful for beginners to know, also leave those terms in the comments below and let's share the knowledge with each other. Also, before you go, make sure you have that notification bell hit so that you know every time we post a new video in this series. And we're also going to be posting other content sprinkled throughout, so we're not just talking about investing every single week. So make sure you stay tuned for those videos as well. Thanks so much for watching, and I'll see you in the next video.